welcome to the Monday Futures Market Outlook for January 17th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, a 5-day complimentary membership is available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. When we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. Over the last year, we've gone through numerous false start signals above and below that 80-week moving average. But the 80-week moving average is distinctly trending higher, and at the same time, we are trading above it now. This at this stage continues to remain relatively optimistic. We've now exceeded the last little swing high, and it's likely that the market is heading to retest its 2011 market highs up towards the 1340 to 1350 area on the upside. And we'll be watching what happens, but at this stage we remain relatively positive this market. Just to make some key intermarket observations, overall this market has seen a substantial weakening in the euro, and the euro at this stage has finished some measured moves lower. If at any stage the euro just goes through a short squeeze bounce that sees a 400 or 500 pip bounce higher, it will take a cool off the US dollar and allow commodities in the stock markets to continue to rally into the new year. In this type of environment, even if the euro does first weaken a little further, we are in a relatively stable environment. It would be very unnatural for interest rates to fall to historical lows in this stable environment. So we are, even though the bonds continue to edge towards those highs, at this stage we don't believe that they're going to break through this overhead resistance. When we take a look at that S&P 500 chart on the daily charts, you can see we now have broken above that October high. There are a number of measured moves off of this flag that indicate this could run out of steam in this 1300 to 1320 area. But we certainly can't rule out the possibility that we just slow crawl, especially on some positive earnings, up toward the 1340 to even 1370 levels on the upside. Overall, we remain relatively optimistic this market, even though we're starting to hit some overhead resistance levels and places where 1 or 2 day profit taking cycles are likely to occur. Overall, there's very little reason to anticipate there at this stage there to be some very bearish price action. So we're probably going to be looking for all pullbacks as buying opportunities. Next year, when we take a look at the US dollar index, and this is what we were talking about on the currency front, overall there's been a distinct trend of the US dollar moving higher during that massive euro devaluation over the last 3 months. At some stage, if the euro does bounce, it is quite possible that the dollar index could even drop as low as the 78, 78.50. It doesn't have to go that low, but it certainly would not be unnatural for it to do so. If we during that kind of a US dollar consolidation, it would allow commodities to remain relatively optimistic, at least on the short term, and that could be the fuel that accelerates the stock market even further during this time frame. So let's watch whether or not this trend line is broken on the downside of the dollar. Next year, when we take a look at copper futures, copper has been behaving very well. We were not as optimistic on copper as things like crude oil, but overall copper continues to demonstrate that there's some meat on the bone behind it here. At this stage, if copper can actually break to a higher high, it likely is going to work its way back up to test the lows of August of last year, roughly around the 390 level. We don't believe that copper is going to be making any new bullish push up towards, let's say, 460 on the upside, but there definitely is room for an extra 20-30 cents on the upside as copper works its way to test some overhead resistance levels. Next year, when we take a look at crude oil, we remain relatively the most optimistic about crude oil over all commodities. Crude oil has now been creating this flagging formation right here. And while some traders have been teasing the idea of double tops and trying to catch these low reversals, at this stage there's no evidence that the primary trend of crude oil that's been in place for the last 4 months has really changed. At this stage, all we need is one break of crude oil above this flagging formation correction, and it's going to be off to the races towards a 108, 110, and potentially even the highs at 113, 115 at this stage. Especially if the U.S. dollar begins some selling, it'll allow crude oil to potentially have another push higher. Next here, we're going to take a look at gold futures. We're overall not as optimistic on gold as we are on things like crude oil. Gold is actually behaving relatively well. It's nicely bounced off those lows, but we're still going to give, as we approach these Fibonacci zones in this 1650 to 1700, we're going to go with the first approach that this is going to act like an overhead resistance level. If gold continues to demonstrate strength through these levels, we'll have to reassess our outlook on it. But at this stage, we're going to go with the attitude that gold will initially find overhead resistance in the next $40 on the upside, and probably have to come back for a retest of some sort of a retracement before we can take a different outlook on it. Finally, when we take a look at that 30-year Treasury bond, you can see that the Treasuries continue to edge a little bit higher, a little bit of a kind of a reversal indication this morning, but not much. At this stage, if this was just a stock chart, we would be pretty bullish on it. But we're just trying to, think through what kind of an environment would really push 30-year Treasury bonds to all-time highs. As if the U.S. dollar is weakening and commodity prices are actually rising, it puts inflationary pressure into the system, which in fact would force interest rates actually higher and not lower. And so really at this stage, we're even though we're approaching these overhead resistance levels, we're right now pretty much negative on these, thinking that this overhead resistance will reject here unless obviously something bigger picture like a catalyst occurs that really sparks something underneath it. That was your Monday Futures Market Outlook. Thank you for joining me.